Well, hello, Providence Financial friends and family. Hope you are all doing great. Periodically, I like to put out a video just giving you a broad update as to what's going on in the markets and some things to expect and maybe some risks and recommendations. So I'm doing that. Part of the reason I'm doing it is because one of you reached out to my office and basically said, "Hey, where's Anthony? Is he okay? Because we haven't seen a video from him in a long time." And I thought that's kind of funny. And I went and looked, and it looked like that person was on our email list and everything was good. And then I went back and looked and realized that it's actually been 7 months since I did a video. So long time. And I apologize for that. I don't want to get on and do a video just to tell you what you already know. And for the last 7 months, it's been essentially smooth sailing. There hasn't been a huge, a lot of things from a video perspective. I mean, there's been a lot of things going on with the wars and bombing Iran and Israel and Iran and all that. But from a perspective of here's information that's dire for you to know, there just hasn't been a lot of that. As well. So I am going to attempt to give you a little more of a market update, a little more periodically than every 7 months, maybe on a monthly basis. But I did jot some notes down. There are some things that we'll take a few minutes and talk about. You guys know that I can be long-winded, so I'm going to try and keep it short and to the point, and just give you some basic overall information as well too. So let's talk about the market real quick. There's a couple things that questions that we get about the market. The wars is certainly one. The tariffs is certainly one. Inflation, GDP. Are we gonna have a recession? So those are all things that we probably should talk about. Interesting enough, when we talk about the wars, I would have thought that the market would have had a huge negative reaction when it came to the war, and it did a little bit. It almost like it had a little bit of a hissy fit, and then it ended. Same thing with oil. Oil shot up because the wars in the oil region, right? And then it just came back down. So the market is almost like ignoring that even happened. So I'm not seeing that the war is really going to have a long-term effect at this point with the information we have on the stock market. It's just not looking like it's going to happen. Tariffs, another question we often get, another something that's in the news. I've talked a lot about it in the news and some of the live media interviews that I've done. And by the way, I've done a lot of them. If you haven't seen the live interviews, you want to see them, they're all on our website, providencefinancialinc.com. You can go watch the interviews. And it's also a good way to stay in touch because as I'm interviewing, and doing these live interviews, it's relevant to you too. So it's a good way to stay in touch. We do send them out. When I do them, so we send them out. So you should be getting them, but something to watch. They're only 6 or 8 minutes. But when it comes to the Trump tariffs, the question is, is that going to increase inflation? What's going to ultimately happen? In the professionals that I've talked with, the analysts that I've communicated with, all have kind of said, in the previous that if Trump tariffs settle in around 25% on the much higher end of what he had talked about, it would absolutely have an inflationary impact. It would affect consumers and so on. But if it was more in the 10% range on the lower end of what he talked about, then there might not even be any impact on consumers at all. So it has been on the lower side. I talked to someone the other day that had done a lot of research, and basically they said that the Trump tariffs had averaged around 13%. I didn't verify that, but it's certainly on the lower side. And the reality is that it hasn't caused inflation. It could be for a couple of reasons. It could be because companies front-loaded. I do know of people that front-loaded, companies that front-loaded inventory, meaning that we know the tariffs are coming. Let's buy everything we can now, put a bunch of it in warehouses, and then have it for the future. So it just hasn't been passed on the consumer yet. That could be one reason. Consumers front-loaded too. I was talking with an individual before Liberation Day, and when I was having a conversation with him, he said, I've been looking to buy my wife a truck, so I bought her a Tahoe, and I went out and bought it before Liberation Day, before tariffs. So I think a lot of consumers were smart and kind of front-loaded it. So we haven't felt the effects for those two reasons, but it could also be that manufacturers are going to wind up eating it. They want your business. They know that there's a supply-demand equation, and a lot of these companies are very profitable. And so if they just decide to eat it and pass it on to you, then that becomes less inflationary for you. They would rather have a little bit of a discount. It's almost like giving you a 10% discount, right? So they would almost, rather take the 10% off the top and then not lose any clients or any client share, market share as a result of that. So that could be as well too. But the tariffs at this point haven't seemed to be problematic. But if the inventory thought is correct, and if this continues to go on, then it could still get passed through. But right now, there's not a huge concern about the tariffs being passed through. The ultimate concern is inflation, and inflation numbers have been down. If you're looking at, it depends on what measure you're looking at. If you're looking at the CPI or the PPI or the PCE, those are all the PPI, I think, was 2.2%. That's the producer price index. That's inflation on the wholesale prices. It's a leading indicator because if you know that wholesale, what companies are paying wholesale for goods and services, if that's low, then the ultimate product that's going to come out to you is going to be low as well. So it's what's called a leading indicator. You can take a look at these indicators and you can go, okay, well, if that's low, then this is what's going to be the end result. The producer price index was low. It means that probably CPI is going to come down. PCE is going to come down. CPI and PCE are very similar. I won't get into the differences, but those are the retail measures of inflation. And they just measure things a little bit differently. But inflation has come down. And it looks like it's probably going to continue coming down. That could change if the tariff, for some of the reasons that we talked about with the tariffs. But right now, there's not a huge inflationary pressure. That also is going to have an impact on GDP. And actually, before I go on to GDP, let's go back to inflation really quick because these measures have come down. But there is one other point that is also telling us that inflation could be on the softer side or maybe stay where it is. And that is the labor market. A couple of years ago when I was reporting on the labor market, there were roughly 2 jobs available for every worker. I think the number was 1.9. I don't know that it quite got to 2, but there were 2 jobs available for every worker. That means that it's a worker's market. It's a worker's environment. You've probably heard the term seller's market or buyer's market when it comes to real estate. Well, in the employment world, there's worker's market, employees market, or employer's market. Well, if there's more jobs than workers available, the demand for workers goes up and it drives wages up. And so what happens is companies have to pay more just to keep good people, because if they don't pay more and you have an employee that realizes that they could quit and go get a better job somewhere else, less money, work remote, or more money rather, and work remote, then they're out there looking. And if they're a good employee, you get to pay them more to keep them. It's very difficult or very, very expensive to replace an employee. It's usually much more worth it to keep an employee that you already have than to try and go and find a new employee. Oh, by the way, if you're going to find a new employee, you're going to have to pay them more as well, because otherwise you're not going to attract them. So that's what was happening a couple years ago. And in order to keep people in my company, we've given raises. A lot of my people are making great salaries, great figures. But what that is that creates inflation, because that has to be passed on to you. If a grocery store has to keep good employees and they have to pay more, well, they have to raise the prices to pass those on to you. And commodities, speaking of grocery stores, a commodity can fluctuate seasonally, right? If corn and grain and other commodities go up, then they're going to adjust their prices accordingly. You're going to pay more, but then as they come down, then they can lower their prices. And it's seasonal. Grocery stores and suppliers can adjust up or down. Well, you can't do that with wages. So wages were higher. I had to pay people more, give people raises to keep them. Companies had to pay more just to get good people. Well, now that the labor market has softened, today there's really only 1 job available per worker. So it's much more equal at this point. The equilibrium has balanced itself out. But what I can't do is I can't go back to my employees and go, hey guys, so sorry, I gave you a raise back then when the labor market was tight, and now we're going to take that back. No, it doesn't work like that unless you want to lose your workforce. So the reality is that it's what's often that labor, the raises that I had given people in the past are sticky. And you might hear that term called sticky inflation, where that's what it means. It means that I can't go take that back. That inflation is permanent. My costs are permanently higher because of that sticky inflation. So you've heard that term, inflation is sticky, and that's part of the reason why, because of the labor market. It's sticky. And I think that's just kind of important for you to understand. So it is softening. The Federal Reserve has a mandate to try to keep inflation low and to try to keep unemployment low. So full employment high, inflation low. That's what their mandate is. And their target is 2%. And they're really looking at the PCE, the personal consumption expenditures measure. And I think the PCE was 2.8, I think. Don't quote me on that. But I think it was. So it's not quite at 2%. But at the same time, they're not going to wait until it gets to 2% to start lowering rates. Because if you wait till it gets to 2%, it's too late. They've got to start ahead of time. So they have this balancing act. They don't want to be behind the eight ball like they were with inflation when they were saying inflation was transitory right after COVID. So they don't want to wait too long, but they don't want to lower interest rates too early as well too. So inflation is one of the things that they're looking at, but it has been softening. It has been coming down. The labor market's been getting softer, as I just mentioned. So everything with inflation is going in a good direction. Now, that takes us to GDP, and GDP, gross domestic product. Gross domestic product is how you measure an economy. Every time you buy something, a goods or a service, it adds to GDP. And you typically want GDP to be somewhere in the 2 to 3% range. It means there's 2 to 3% growth, and you want an economy to grow. 2 to 3% is not bad growth. Now, part of what the Federal Reserve wants is they don't want it to grow too fast. They don't want inflation to go too high. So that's where they're going to use interest rates. So gross domestic product for the fourth quarter of 2024 was at 2.4%. For the first quarter of 25, gross domestic product was at a minus 0.5%. So a 3.1% swing. That's significant because, again, it tells us what's happening and whether people are spending money and what the economic output is. So the economic output, GDP, is slowing down. Well, what are the implications of that? Well, the implications of that is that we're not out of a recession yet. That's the implication. Let me rephrase that. We're not out of the woods of having a possible recession. We're not in a recession. I think that might be the way that it came out. But we're not out of the woods about having a possible recession. We could. Now, that's not bad. The media make you think it's bad. No, our word, we don't want a recession. If there's going to be booms and busts, it's really not a big deal, especially if you're invested for income like the way we talk about. It doesn't mean anything, but it does mean that, that we could, have a recession. And it could mean something for your workers and your friends and your family who, don't have the same peace of mind that you guys have because they don't know what you know. But it means that we could have a recession. The Federal Reserve is on target, and it's widely predicted to lower interest rates in the second half of the year. The next meeting that they're going to have to do this is in July. I don't think they're going to lower rates in July. Maybe they do. They could. Maybe they lower by a quarter point. But certainly between now and the end of the year, unless something changes, they're probably going to lower interest rates. So the question then is, well, how does that affect you? The Federal Reserve's moves, what is that going to affect you? And I think it's probably a good time to switch subjects to just remind you of how income portfolios work and kind of let you know where they are. And then I'll tie in how does the Fed affect you into that. So you guys know the story, right? For those of you that have been around for years and decades, you know how income portfolios work. It's kind of ho-hum. You're kind of listening to me and it's the same thing. But if you're a newer client, it's a change. It's a change of habit. You've been saving for 40 years and putting money in your accounts for 40 years. Now all of a sudden you're retired and here you are with a portfolio that's generating you income and it's not growing and it's not even tied to the stock market. And so it's different. So I understand that. And, I'll try to overcome that. But so just a brief reminder that when you're focused on income, it's not about the stock market. You're in portfolio and investments that are designed to give you interest and dividends. And if you're in the norm of most of our clients, then you're going to be netting after fees somewhere between 5 and 6% a year, depending on your allocation. 5 and 6% a year of interest and dividends. And for some of our newer clients, it's important not to confuse interest and dividends with total return. Total return includes the fluctuation in your portfolio. And your portfolio balance is going to fluctuate. But regardless of the fluctuation, your income is going to remain the same. And when you look at the income portfolios over the course of the last year or so, I don't have the exact numbers, and I get reports, I just don't have them in front of me. But I'm going to say that most of the income portfolios that you guys have are probably down over the last year, maybe 2 to 3%. Maybe there's a few outliers outside of that, one way or the other, but probably 2 to 3%. Now, if you're a total return focused retiree, meaning all you care about is the bottom line, then that's going to bother you because if you're focused on total return, if you're focused on accumulation, if you're focused on that, then all you look at is the bottom line. Well, there's a bigger story than the bottom line. If you're invested for income, the bottom line doesn't matter. If you're focused on growth, the bottom line matters. But if you're focused on income, like all of you are, if you're a client of ours, that's why you're a client, is you're focused on income, then the portfolio value at any point in time doesn't matter. How much income you get from your portfolio, that's what matters. Okay, that's what matters, is that income. And so I think it's important to just be reminded of that, of how it works. Your portfolio value is going to fluctuate, but your income's going to stay the same. And I'll throw a number out there so we can put something concrete just as a pure example. Let's say that you have $1 million and you're getting $50,000 a year of income. That $1 million might drop. I mean, if that $1 million drops 5%, that's $50,000. So it might go to $950. But guess what happens to the $50,000 a year you're getting? You still get it. You're still getting that $50,000 a year. So if you're living off the $50,000 a year and you're not selling principal to get it, you're living off the interest and dividends, then what impact did that drop in value from $1 million to $950? What impact did that have on your income? None. That's the beauty about being invested for income. It doesn't matter. So if you're living off your income, the fluctuation is just noise. You're living off interest and dividends. You can count on that $50,000 a year in our example, year after year. Now, what if you're not spending it? What if you say, well, Anthony, I want my portfolio to grow. I don't need it. I've invested for income so I can get 5 or 6% a year, but I do want it to grow. Well, in that situation, a drop in value doesn't actually hurt you. It actually helps you. Here's why. Because if you start off with $1 million and it goes down by 5%, it fluctuates down, and you're getting $50,000 a year. Well, now what you're doing is you're reinvesting that $50,000 a year, which means you're buying more income investments. But because the value of your portfolio is down, that means that the value of the investments inside your portfolio is down. So when we take this $50,000 and we invest it, and we continue to reinvest it for you, we're buying investments on the cheap. We're getting them at a discount. The same investments you have, we're just paying less for them. So when the portfolio bounces back, you're going to come out smelling like a rose because you've bought more shares. You've bought more investments at a discount. So if you're living off your portfolio, the income from your portfolio, that income's not going to change based on the fluctuation of your market value. And if you're reinvesting your interest and dividends, then it's actually helpful that the market drops because now you get to reinvest at a lower price. So it's really kind of a win-win, and that's the beauty about being invested for income. And I know we've talked about this before, but the reality is that's the beauty is you really can't lose. Where we start to see problems, and where a lot of people, I don't want to say a lot, very few actually, but where some of you have had questions is with a little bit of impatience. It's almost like, we invested today and 6 months later our portfolio hasn't doubled in value. Well, it does take time. It really does. This is a multi-year process. We're not investing you for. Sorry, I did. Someone had the gall to call me while I was in the middle of a sentence. So we're not investing you for the short run. We're investing you for the long run, right? You might have 20 or 30 years to go. I don't care what happens this 6 months or the next 2 years or the next 5 years. This is a year by year thing. It's not a month by month, but we tend to get impatient and it could be easy to think, well, it's not working. Well, no, it's not working in a short time, but it is working in a short time. You're just not seeing the results in a short time. So, and I think that's important to just acknowledge and just point out. But the reality is your portfolios are doing everything that they're supposed to be doing. If you're getting income, you haven't seen your income change. If you are not getting income, if you're reinvesting, that's a good thing because you're buying things on the cheap. Now, let's go back to the Federal Reserve because this comes into play. The Federal Reserve, the biggest thing that affects the value of your portfolio is not the market, not the stock market. It's interest rates. And that might confuse some of you. I had a conversation with someone recently that said, well, the market's up, but up to almost record highs, but my portfolio is down a little bit, so I'm a little confused. Well, it's because you're not invested in the market. You don't have the risk of the market. If you want to have the risk of the market and you want to get the results of the market, then you have to be invested in the market. And anytime you're invested in the market, you have to be prepared. You have to be able to sustain a massive loss. The market's lost 50% or more twice in the last 25 years, and there's nothing that says it can't happen again. And if you can afford to take that risk, great. But I know that you can't. And if you can't afford the risk of a 50% loss, then you can't be in the market because it could always happen again. Okay. So the reality is that you have to be able to take that risk. And the reason you're a client of ours is because you don't want to take that risk, or at least not with all of your money. You're focused on interest and dividends. So when someone asks me, well, why is the market at record highs, but my portfolio is not? The answer is the same. That's because you don't have the risk of the market, and the market is not the gauge you need to compare it to. The market is not what's going to affect your portfolio. What is going to affect your portfolio more than anything else is interest rates. And when it comes to income portfolios react opposite of interest rates. So when interest goes down, when interest goes up, rather, your income portfolios are going to go down. When interest rates go down, your income portfolios are probably going to go up. Okay? So it's interest rates that affect your portfolio more than anything else. And so when you look at the market, you're just looking at the wrong gauge. You know, if you have a pickup truck and you're trying to figure out what the value is, you can't look at Porsches to determine what the value is of your pickup truck. They're two different things. Now, the Federal Reserve, as we talked about, is most likely going to lower rates over the next 6 months. So is that going to have a positive impact on you? Probably in the long run. Okay, it may not happen instantly. If the Federal Reserve announces in July that they're going to lower rates, are you going to see your portfolio bounce up? No, probably not. Because the Federal Reserve controls short-term rates, and you guys aren't invested in short-term investments. You're invested in long-term investments. They do not control long-term rates. The 10-year Treasury, which is the typical measure of longer term, has been sitting, I think it's at 4.25%, and it's been hovering in that level. It's come down a little bit, but not a huge amount. So, but as the Federal Reserve over the course of the next few years lowers rates, you should start to see your portfolio go back up. How much do I care about that? I don't. It doesn't matter, but a lot of you do. You know, it's so ingrained to look at the bottom line that you look and you feel better when it goes up. But you know, so I do want to let you know that that's probably what is going to happen, but it's a year-long process. The Federal Reserve raised interest rates pretty quickly after COVID because of the spike in inflation, in May of 22, I think, and it's brought inflation way down. Well, if we have a recession or we have a stock market crash, something like that, then the Federal Reserve will lower interest rates right away, and you'll probably see a significant imbalance in your portfolio. If that doesn't happen, it's going to be a long process. And what does that mean? I don't know. 1 to 3 years, maybe. So it's not something that's going to happen month to month to month, but you'll gradually see it increase. Again, I don't care, because if you're living off your income, you're getting your income. That doesn't change. And if you're reinvesting your income, the reality is you actually don't want your portfolio value to go back up. Keep buying things. The best thing that could happen for you is it stays where it is, and you continue buying on the cheap. You continue buying your investment at a discount. If that can go on for a couple more years, then when eventually it does pop up, you'll come out smelling like a rose. So some thoughts there. What are, just looking at my notes here, what are some possible risks? Well, I think terrorist attacks on the list, right? I think more so than ever. And if you remember what happened in 2001, right? That's really what started the crash of 2001, was a terrorist attack. And that's something that can happen just like that. And if you're overexposed in the market, that's something that could just change overnight. Terrorist attack, inflation. You know, if the Trump tariffs do actually start to cause inflation, it's still open for debate. But if they do, if inflation goes up, if China doesn't cooperate, and so on, and Trump with these, inflation war just gets out of control, the inflation could spiral out of control. If inflation spirals out of control, the Federal Reserve is going to have to raise rates. And that's not going to be good across the board for GDP, for economic environment, and so on. Recession. We talked about that. Still not out of the woods of a recession yet. That's still possible. And then stagflation. That's something we haven't talked about, but it's a word that's being tossed around. What is stagflation? Stagflation is when you have an economy that's not growing, but there's still inflation. So it's a stagnant economy, stag, with inflation. That's what stagflation is. So without getting into all the weeds, other than that, it's not good. You don't want an economy with no growth, but inflation is still continuing to get out of control. That's a possibility at this point. We just had our first quarter in a while, at least, I don't know, I'm going to say 1 or 2 years. I'm not exactly sure, but we just had our first negative quarter of GDP, Q1 of 25, that we've had in a long time. So that's negative. That means negative growth for that particular quarter. Doesn't mean it's going to stay that way. We don't know. We'll see. But it is trending downward. So those are a couple of risks. What are the recommendations at this point? If you have money that's in stock that you cannot afford to take a big loss on if we have a terrorist attack or if there's a recession or anything else, it might be time to take some chips off the table. All the major indexes are within like 1% of their all-time highs, and the whole goal is buy low and sell when high. Well, you can't sell high unless you actually sell high, and most people miss that. Now, I don't know where we are. I don't know if this is the high and something happens and then the market goes down from here, or if we add another 5 or 10 or 15%. I don't know. No one knows. But if you can't afford to take that risk, that risk of another major market crash or terrorist attack or war, if you can't afford to lose whatever money or half of whatever money you have in the market, then maybe it's a good time to take some chips off the table. And if you want us to review those, outside investments, just call Tuan. Feel free to do that, or call me, and we'll go ahead and review those and see if it makes sense to leave them or if you want to reduce your risk. Another recommendation, we talked about this. I have it jotted down. Don't worry about the portfolio value. Again, it's not about the portfolio value. The only value in the portfolio going up, your value going up, is you feel better. But for all the reasons we talked about, the portfolio fluctuation is just noise. It doesn't matter. The third thing, and this is a big one, and that is annuities. So another way that interest rates affect income portfolios is with annuities. When interest rates are high, financial institutions can pay more, right? That's why when the Federal Reserve raised interest rates, your CD rates went up, the money market rates went up, the savings accounts rates went up, everything went up. And these are all short-term investments. But in the world of your retirement, which is long-term, annuities are a long-term investment. And interest rates high now means that annuities can pay more interest over a longer period of time because of the environment in which you bought the annuity. And over the last 2 years, you had a window of opportunity with your annuity to upgrade the annuity, because I'll make a statement that is true. I'm going to say 95% of the time. And that is that if you bought an annuity 3 years ago or more, it is not nearly as good as the annuities you can get today. Not nearly, because interest rates today are very high. 3 years ago, interest rates were at 0.25%. Today, interest rates are at 4.5%. The reality is that's a significant growth. If you buy an annuity today, it's going to most likely, there's a few exceptions, but it's going to dwarf the amount of interest you could have earned you could earn on an annuity that you bought 3 years ago. Even if you have to pay a penalty, and I don't want to make a blanket statement, everyone's a little bit different, but a lot of times it's made sense when you look at the numbers. Even if you had to pay a penalty to upgrade your annuity, a lot of times it makes sense. And for the last couple of years, we've upgraded almost every client that we have. We've reached out to you, we've contacted you, we've upgraded you, and you realize it makes sense. But if there are a few holdouts, if any of you maybe for some reason slipped through the cracks, I hope that's not the case. Or if you decided that for some reason you didn't want to change, or you have outside annuities that are not with us, please let us review them, because as soon as the Federal Reserve starts to lower rates, this window of opportunity goes away. And if you call me in 6 months or a year and go, hey, time to upgrade that annuity, well, guess what? In a year, you're probably not going to be able to get what you can get today. I've been an annuity expert for 25 years. I've never seen annuities as good as they are today. So at least have Tuan review them. Tuan's an annuity expert as well. For those of you that know Tuan, I think all of you know Tuan. He's been a financial advisor for a long, long time. I think he's coming up on 20 years. He knows his stuff. And so if you have an annuity and you just want him to review it, have him review it. It's pretty black and white. But I'm going to suggest that that's probably a recommendation as well too. Final recommendation. I think most of you know that I have a podcast. I I don't think we've crossed over 400 episodes, because I actually want to record a 400 episode special edition, but I could be wrong. I might have missed it. But either way, we have hundreds of episodes on there, and everything is designed to help you. You could go onto our podcast website, providencefinancialpodcast.com, and put in a keyword, and I guarantee you, if there's something about retirement there, it's going to be there, and you can go listen to the podcast. Pretty informational, pretty educational. If you if you listen to podcasts on your phone, just download the Providence Financial Retirement Podcast and plug it in, and you'll find it informative. And if you learn anything that you need to talk about that we haven't discussed with you before, myself or our firm, you can feel free to let us know. So we do our best to try and keep you educated. Hopefully this video has been evidence of that. I apologize for not getting one out for the last 7 months. I'm going to make an attempt every month to try and get one out. But for now, if you have any questions for me or my staff, you know that we're always available to you. Thank you for being a loyal client to our firm, and we'll look forward to staying in touch. God bless.